Making money while you sleep is the fundamentals how the rich got richer and the poor get poorer. The poor trade time for money, whereas the rich let money work for them while they are sleeping. They put their money into investments that continue to work 24/7. And that's a variety of investment diversified across different platforms, different countries, and different asset classes that works continuously and picks up the different trends that's in the market. They're not worried about things going down in one market because they pick it up in the other, while the poor puts money into select few strategies or into one strategy, and if the market crashes in that one strategy, they lose all of their wealth. So, how can you build multiple streams of income is actually the key to financial freedom and wealth. Now, multiple streams of income, most people think, well, I work, I might trade shares, I might have some passive income that comes from my property portfolio. That's my multiple streams of income. Now, are they multiple streams of income that's actually working effectively for you? In this video, I'm going to share with you how to build out multiple streams of income that's sustainable, that grows over time. So let's dive in. Now, one of the big things that are different with the wealthy is that they invest across the board. So they invest across all Australia, and they invest in not only commercial property, also residential property, hotels, boarding houses, into shares, into companies, everything. Now, you might only have a small pile of money versus someone who has millions and millions of dollars, and you may not feel that this is the right time or you can get your hands onto everything. Now, there's this sure key way of being able to do that. Now, firstly, it's strategy and planning. Now, you would find that the wealthy actually spends a lot of their time planning, then finding the right professionals to execute. They don't cut corners. Right? In my experience in the last 10 years of investing in commercial property and building wealth through commercial property, I've helped some really wealthy individuals in Australia build amazing wealth and cash flow through commercial property. We've built $20, $30, $50 million portfolios. And currently, I run a retail fund which helps everyday Australians to become wealthy through accessing the high-end properties with better returns in both cash flow and growth, and trickling down so that they actually get that returns back to them. Now, one of the key things about that strategy is getting crystal clear vision of where you want to go. Now, I spend a lot of time with our customers developing out that crystal clear vision because I know that's how the wealth gets wealthy, right? So that's the number one thing. Develop your strategy. And your strategy might be multiple streams of income. So let's look at that. Now, if you want multiple streams of income, you're going to need something to replace your work income eventually. And that most likely would need to be passive income. And that passive income for most Australians is developed out through investing in property. Now, whether that's residential or commercial, that's entirely up to you. But if you look at the wealthy, they often have both residential and commercial in their portfolio. So you should follow suit as well. You should be looking at the Frank Lowrys of this world. When you look at Harvey Normans, the people who Jerry Harvey made his money not from the businesses that was in Harvey Norman, but from the properties that Harvey Normans were in. If you look at McDonald's, people think McDonald's is in the business of real estate. It is, but it is in the business of commercial real estate and not residential. And this is where it's important. Now, if you want that multiple streams of income, that continuous stream of income, you need to consider both growth and cash flow. Your portfolio need to have a certain amount of growth, and that growth is somewhere probably between 5 to 10% per year, and cash flow. Now, that cash flow should come out somewhere around anywhere from 5 to 7% of your whole value of your portfolio. Now, why is that? Is because if it's any less than that, you really can't pay the bank and live off it, right? So what you want to do is start small and build. How do you start small and build? Is to have a plan that you're both going to invest in commercial and residential. So if you have residential property already, you need to go into the commercial pathway. Now, I run a company called Unikorn Commercial Property. We are a commercial property buyer's agent and educator. What we do is we help everyday Australians become wealthy through commercial property. Now, what you do with commercial property is all about passive income. So how much deposit do you have? Let's say you have $200,000 or $400,000. You can buy anywhere between $500,000 to $1 million in commercial property. With that commercial property, everything commercial is traded on net returns. That means that unlike residential, where they give you a return where they say, oh, it's a 7% yield, but from there you have to take out 2 to 3% of outgoings, then what you have in hand is about 3 to 4% where you have to pay the bank and you're negative. Now, in commercial, that doesn't happen. When they quote a 7% yield, it is a net yield after all the outgoings. So that means if the interest rate sits at 6%, 6.5%, 6.75%, you're still making money from that property, regardless of the interest rate being where it is. So ultimately, it's about building multiple streams of income. So you've got to plan out your income. So firstly, we'll use commercial property for cash flow. We use residential for growth. So residential you have to support. So you need the cash flow in your commercial property to support your residential. So your journey needs to balance out your cash flow and your growth. And the more cash flow you have, the more you're able to support the growth of that property. So your property, let's say in residential, could be negative $30,000 a year. That's all okay if you have $30,000 coming from your commercial property to support it, because ultimately your residential property may double in value in 5 years' time. Most people hope in 3, but 5 or 7 years. Commercial property may take a little bit longer, but the thing is, as this property goes up in residential, you can use the cash flow from your commercial to refinance against the equity without relying on you. See, the name of the game is to take the reliance off you, because if you look at all the wealthy people, they're not reliant on themselves to earn an income. They're relying on the growth of their company, the company income, their passive income, all through their investments. And that's what you need to do as well. So when you look at that, you get your cash flow, and you've got your growth. As your growth grows, so does your cash flow on a yearly basis commercial property. You leverage off that growth of the residential property. Together, you come up with another deposit to allow you to do again. Now, when you have it again, you should be diversifying that across different areas in Australia. So let's say you started out in Melbourne or Brisbane or Sydney. Let's say that you've got a couple of properties in one state. That's the hardest thing to do, is to diversify rather than keep holding it in one state. Now, I know that you feel comfortable, most people feel comfortable investing in their backyard, but one thing that COVID has shown us is that if you invest in your backyard, you are actually susceptible to cyclical changes and to changes of great unpredictable events. During COVID, what we didn't realize was that different states behave differently and grew differently. Brisbane has come ahead as one of the top performing areas and suburbs in around Australia because they were open much more sooner after COVID, allowing the economy to reboot. Whereas Melbourne have slagged behind, are still probably 2 years behind the rest of the country because there was much harsher lockdowns, right? So that's the fundamentals of the investing. If you had all your eggs in Melbourne, your portfolio is now lagging 2 years behind, and you're probably losing out on about 20% in your returns. Whereas if you put it into Brisbane or spread it around, you would have picked up the Brisbane gains, which had actually seen properties double in the last 5 years, and that would have made up for any losses you made in Melbourne, right? And that's where the key message of diversification comes in. Now, after you have a pile of money, so let's say you started with one property, that's growth property in residential, then you have a property in commercial that is cash flow. Together, they can help you get refinance against the equity on the residential property. You now have another deposit. Now, that deposit probably should be invested elsewhere in around Australia. So if you're in Sydney already, you need to go to Melbourne or you need to go to Brisbane, and that's all about your strategy. You need to diversify. If you have industrial, you need to go to retail. If you have retail, you need to go to industrial. You might need to go to office spaces, whatever it is, because it's all cyclical. Remember 10 years ago in commercial property, you could get 8% returns in industrial property and no one wanted it because every second warehouse was vacant. Today, not every second office space is vacant, but a hell of a lot of vacancy is stopping people investing in office space. But it's cyclical. In 10 years' time, we're probably all chasing office spaces and no one wants warehouses back then. So you've got to think ahead of time. You've got to proactively invest. One of the big things about it is most people invest for the now, whereas the wealthy invest for the future. They look at their goals 5-10 years ahead and says, where do I want to be? And they scale that back in their investment and work out now what's the steps they need to take. And that may mean that they take a lesser return right now in an investment, knowing that they're going to get a better return in 5 or 10 years' time because they've got a much longer timeline in their decision making, in their getting their return on investment. If you want to then diversify, let's say we've gone back to the pool of money where we've got the growth, we've got the cash flow refinance, and we've got this pool of money. You can invest in other things. You can invest in a business, which will give you some passive income, things like potentially laundry mats, things like different types of vending machines, not the vending machines that we see, not those Pop Mart vending machines that are vending like these kids' figurines. But one of the things that do phenomenally well is positioning vending machines in areas where kids are seeing little cars, where they're near food places, and kids will be able to, that nagging power, right? Potentially, those fairy floss machines that cost $7 a fairy floss in areas, those are passive income areas you could earn, right? So looking at passive ways. Alternatively, if right now, like you're only able to get out a couple of $100,000, one of the big things to consider is going into a syndication with someone else. And the wealthy often do that when they're trying to access larger and larger deals. When we look at some of the biggest oil deals in the world that's been done, they are often done in conglomerates of 3 or 5 different companies coming together from Britain, from France, from China, coming together to do a deal, right? So you should consider doing a syndication if you only have 200,000 or 300,000, but the returns are just lackluster on the lower level. Because one of the things you've got to consider is as you go up the level, you actually get better returns, right? So the higher you go, the better returns that you get. So if you could come together with someone else, buy a property that's larger or 2 or 3 times larger than what you can afford, you actually get that high level return in both cash flow and growth as well. Now, that's the fundamentals of why I started a retail fund, because everyday Australians can access those properties outside that traditionally go to people of high net worth. What we're doing is acquiring those properties, breaking them down and giving you a higher return compared to the return you would get if you went out on your own. Now, diversification is the key. Now, if you want to continue to build wealth while you sleep, you need to make sure you have passive income. Passive income comes from commercial property. It is the one and still the best strategy out there for investing for passive income. From there, couple that with the growth in your residential property, you can get the level of growth that you need to get to your financial freedom figure. From there, then you want to diversify that into all around Australia in terms of investing all across Australia, different types of property. So if you are investing in, let's say in Perth right now, you need to then invest over here in the eastern suburb into Brisbane, Adelaide, into areas so that as the boom happens in the growth stages, you pick up on the boom. As the cash flow increases in different tenants because there's more demand for a particular type of tenant in an area, you pick up on that as well. And that gives you the combination of cash flow and growth you need. Now, passively, you can be a passive player in a syndication, or you can also be a player in a business investment. So you could choose to take your money, invest some in business, and that business gives you an income. A lot of people also go into, with passive income, go into becoming a partner into a childcare centre or into a medical centre where they might either be working in it themselves or they're the passive money partner, right? And that's one of the big ways you can get a leg up in terms of getting multiple streams of income. Because remember, building that multiple streams of income doesn't mean you're fraying your actual investment pool. It actually means you become super focused on your strategy, right? And implementing your strategy. Now, the most important thing we come back to here is strategy. The wealthy spend a lot of time strategizing, building out a plan, and then implement. If you want to do that too, then at Unikorn Commercial Property, we can help you build out a pathway to financial freedom through commercial property. Now, hope you enjoyed this video. If you want more of the same, hit the bell, subscribe, and I'll see you in the next video.